This is the Best Stocks to Buy podcast. We use our proprietary algorithms to screen, analyze, and rank over 6,000 stocks every week. This podcast is made possible by Calpine Management Group, a registered investment advisor firm. If you've been enjoying these podcasts, we're sure you'll like our Saturday morning newsletter just as much, if not more. It is informative but light and includes personally curated articles on investing, money, and just plain leisure fun that we think you would enjoy. Just visit our website at www.connormg.com and click on newsletter to subscribe. All right, on to our presentation. Hi everyone, this is Mathis Connor with Calpine Management Group, and this week we're going to look at the best overvalued stock to sell right now. Today is Monday, May 11th, 2015, and we see that this company is in the electric utilities industry. We see on the opening slide that its 6-month downside potential we have at negative 35.8%. On to the next slide, and we see that the name of this company is called Calpine Corporation. The ticker symbol is CPN. The industry, once again, is electric utilities, and we see their 6-month downside potential at negative 35.8%. On to the quick facts slide. Here's a business summary description for Calpine. Calpine Corporation is a wholesale power producer with operations throughout the United States. At December 31st, 2013, its portfolio, including partnership interests, consisted of 93 power plants located in 21 states and Canada. The company's aggregate generation capacity was 31,289 megawatts. Calpine is one of the largest domestic consumers of natural gas. Their website is www.calpine.com. That's CALPINE.com. The company is headquartered in Houston, Texas. They were founded in 1984. They have 2,052 employees. And once again, the ticker symbol is CPN. Onto the products and services slide. What we have here is a footprint of Calpine's power plants throughout the United States. Their portfolio is kind of spread equally between California, the Texas area, and the Northeast, basically in the Maryland area. We also have on this slide 3 photos of their power plants. One on the East Coast, the West Coast, and also in the Northeast. On to the metrics slide. We have that the annual revenue over the last 12 months was $7.6 billion. The net income over the last 12 months was $946 million. And the cash from operations over the last 12 months was $854 million. The operating margins for Calpine for 2014, they were 28.5%, and in 2015, they're expected to decline to 23.5%. That decline is probably mostly related to lower natural gas prices, which also means lower electricity prices for the company. The trailing PE ratio for Calpine now stands at 9.0, and the forward PE ratio stands at 27.5. So that implies that analysts expect earnings to decline quite a bit over the next year. The PEG ratio is at 2.3. That is definitely a rich number, which supports our bearish view on Calpine as a stock that's going to decline in price. The price to sales ratio is at 1.0, and the price to book ratio is at 2.4. The enterprise value to EBITDA ratio stands at 9.6. The dividend yield for Calpine is 0%. The company does not pay a dividend, and consequently, its average dividend payout ratio is also at 0%. On to the price chart for Calpine. Calpine has been a pretty volatile stock over the past year. On a net basis, the stock is down about 5% from a year ago. but over the period of time, the stock has not been a steady ride for the stock. It has basically oscillated frequently, several times between about $24 and about $20 over the past year, several times. So this is definitely what you would consider a volatile stock, that's for sure. Going on to the next slide, it's called the Why Now, the Bear Rationale. And the reasons we have for Calpine being a bearish stock right now is that over the next year, we and other analysts expect to see decreasing sales for the company. Additionally, the company's valuation metrics are expected to be high as a result of a decline in earnings, projected earnings. And additionally, the company continues to expect to add some debt. That debt is related to a recent acquisition, and is also related to a recent issuance of notes to partially refinance some existing debt, but additionally provide the company some liquidity. So we are bearish on Calpine for three different reasons: declining sales, high valuation metrics in the near future, and additional debt. And the company is already very heavily levered. And on to the summary slide. Financial statement quality for Calpine, we would consider it to be fair. The company is carrying a very high level of debt right now. Just to give you a feel, the net profit for Calpine was $946 million in 2014, and the total debt for the company is $11 billion. And it's expected to increase to $14 billion next year. And profits are expected to also decline next year. So that is a lot of debt for the amount of cash flow and income that this company is earning. So, you know, our view is the financial statement quality is just fair as a result. Yes, it is an electric utility, and yes, they do have some contractual recurring revenues, but nonetheless, they are highly levered even for their peer group. Additionally, the operating margin trend is decreasing. As we mentioned earlier, the operating margins are expected to decline from 28.5% in 2014 to about 23.5% in 2015. The price pattern trend, as we already highlighted, has declined about 5% over the past 12 months, and our expectation is that it will decline further. Overall market outlook is just flat right now, although we are seeing a few more overvalued names than undervalued names. We're just not overly bullish or bearish either way in general. The recent closing price for Calpine was $21.19, and our 6-month price target for Calpine is $13.60. And as a result, this gives this company a 6-month downside potential of negative 35.8%. So it's for all these reasons that we believe that Calpine Corporation is the best overvalued stock to sell right now. We hope you found this presentation helpful, and we'll talk to you again soon. Take care. Just to close, remember that Connor Management Group is a registered investment advisor. In addition to being a source of quality stock investment reviews, we are money managers, not financial planners. Our sole goal is to grow our clients' savings and retirement accounts in a personalized manner as quickly as possible using one or more of our strategies. We can manage all or just part of your IRA account as well as a regular taxable account. Just visit us at www.connormg.com to review our service, or just give us a call at 281-947-2201. Have a great week.